Yeah. Yeah. So just as a word to the wise, if you're running on two laptops or two computers to make sure that one of them doesn't glitch, whichever one that you click to restart the recording on with Zoom will announce that it has resumed recording. And then when you have to go to the other one to click on it to resume, it won't say anything. So I just realized when I went to double check that I hadn't started the recording on the second one. So just when you get into that model, be aware of that. For a long while, all I ever did was operate off the one system and then record it. And then Zoom was acting funny, and sometimes it would disrupt the recording. So I got in the habit of running a second recording session as a passive laptop as a observer. Ever since I've done that, Zoom has never glitched on the original recording. But
Yeah.
let me try to just record it on one laptop, and we're at risk. So there you are. All right, so let's jump into this. I would preface this by saying I had a really good 2-hour session this morning with guys that are in the small group coaching program. I'm going to take about an hour of that one and provide that to you guys as an example of live coaching. And the reason I want to do that is because uh, the gentleman that was doing that, Hamad, started off as a day trader in his professional trading business and got to a level of performance that's satisfactory. And for the last 4 or 5 weeks has been transitioning to extending his trading into swing trading. And some of the insights that came out of the coaching of the last 5 weeks with him, I believe, is very pertinent to the topics that we're talking about here today and in the last session. And it shows sort of a live transition that an actual trader, a professional trader, is doing. Um, and he's running a trading business, and I think all the insights that he's got are pretty powerful. I'm going to share some of the screenshots that he provided me that we talked about, but I'm going to make that whole session available to you as an additional resource for your course because I think it's pretty important. And it also is a testimony, in my view, to the importance of coaching. And I'm going to show you uh, the book on resilience coaching for traders that I wrote Friday night and have hung on the Patreon site. I'm going to strongly suggest you guys consider acquiring that. It's uh, I think it has 30 really good lessons. It'd take you at least 3 months to go through those things systematically. It comes with a self-assessment so you know which lessons to go after first. And it provides a strong background in effective coaching that is similar to what I use coaching Army officers, other traders, uh, executives when I coach them. And I think it's a coach in a box, if you will. And it makes that material very accessible. So I'm going to share that with you too. All right. So this one starts, I think this is a follow-on question, if I read that correctly, where at the first session we talked about uh, how to use some of the indicators for assessing market conditions as a way to guide us in risk exposure on the swing trade. And it happened to use the August 5th set of indicators. And then we kind of walked through the answer to that, which included a discussion of the market classification, um, and then the results of your swing test of applying that to the Dow 30, and then also the risk Z and the ETF2 are time series indicators that can give us a view of the evolving market climate or the seasonality of it. So all those things were good, and the discussion we had last week I thought were appropriate. And then I noticed that Phil, ever industrious, I know it's Phil because it's detail and attention to detail. And Griff is the charming face of the team, but Phil is the analytical engine. And what he's cut out of this thing, out of the weekly reports, is the evolution of the risk Z and how it went through some kind of yin yang process and then stabilized in some chop until right around here it began to break through that sideways chop and then started suggesting that volatility to the downside, or increased volatility, I should say it that way, because the volatility can also be to the upside. But we are entering a period of excessive volatility. And then over the weeks, those next 3 or 4 weeks, you started seeing this. And that actually corresponds with a sharp move down and a sharply volatile move back up to measured support and resistance levels. So if you end up treating this as a normal channel, then you end up getting really increased volatility in that channel. The size of the individual bars of the daily moves are much larger compared to what you see during that grinding period characterized by that sideways chop. And
Okay,
that's,
if I could interrupt, the diagram that you're showing is a smaller window
yeah,
than your face. I see, at least on my screen, your face
my
is
face should be
larger.
small. My screen, you should see my great big large screen
Um,
and not my face. What you that's probably in the way you have selected view
okay,
in
okay,
Zoom. You should put it like on screen or a speaker or I
okay,
guess gallery should show the great big screen.
okay. All right,
Mm.
okay, sorry, thanks.
Yeah, yeah, okay. Just double checking.
Oh yeah, no, it's correct. Yeah, it was my mistake. Sorry.
Okay, recover, relax, Phil. We'll be all right. Yeah, so essentially, to confirm what Dan mentioned in his note, is that I use this as a time series. I'm interested in extreme turning points as an indication of when markets may be reversing. I'm going to fast forward to at some point this morning and look at this weekend's report, because what you're going to see um, is that the volatility later on ran all the way up and then came back down again. And we're at a point where we are exactly at the zero line, almost like this, where when the zero line is here and volatility was favorable and then began slowly to increase, it's now right at the zero line, suggesting it's coming into the winter. And that always is a warning sign that we're about ready to get large volatility. Don't confuse that with saying this is a period of bearish moves. What it means is that when you see the risk Z moving up, you actually have declining volatility. And then you get to some maximum lack of volatility, like up in here. And then as it comes gliding back to the zero line, you are slowly, this is a slow increase in volatility until you get to the boundary of normal volatility. And then from here, you have the possibility of sharp volatility spikes, which means that you will see the risk Z become exaggerated in this direction as volatility increases. But in terms of price, what that means is you had a period of small range bars and then increasingly large ranges until you get to the boundary of normal. And now you could get large moves in either direction. So the way to think about this is when the risk Z is at the zero line and just starting to drop into the red, think of this as a zero state box, direction indifferent. I have no directional bias, so no bias for direction. But what I'm ready for is large moves up, large moves down with expanding ranges, catching the market by surprise. And the slow increase in volatility that causes the risk Z to come down to that zero line was a start of almost like the engine got started and is starting to idle and warming up, and now it's ready to make the burst, the sprint. So what I do on these kinds of times is that I'm ready for a sharp move in either direction, and that's where we're going to see that we are now, a month after this last little view. And the key point to make is that around at the end of early in July, leading up to the middle of August, you have an example of what that increasing volatility looks like here. If you go back 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. This sixth one right here is the market had just moved up into here and had a nice consolidation and then a slow increase. 5, 4, 3, 2, 1. A slow increase in the size of the bars, which is driving the volatility indicator, picks that up right away. And now these short-term moves, you could even become a day trader because you're having larger than normal daily moves. But then these things become directional in one way and then directional in the other. So the way to combine the risk Z plus support and resistance is that when you find key support and resistance points and you suddenly have a sharp move with increasing volatility to a previous support or resistance level, and that fails to fail further, like if this is going to collapse here, this is going to be a huge move to the downside. And we would say that the size of this move from the peak back to support, if that's leg one, then we'd expect another leg that large. But when it fails to fail and you have large volatility developing, it's not surprising to see a largely volatile move in that direction as it fixes the price imbalance and comes back to support and resistance, in which it starts to stabilize at that known resistance point. Now, where we are out here a month later in September is we did another one of these, and it's right back to within a fraction of the previous all-time high. And we're going to see it's at a moment in which the risk Z went up and came down to the zero line and is just starting to peak into the red. So we are exactly at a critical state, a compound critical state, based on the two things that affect short-term trading the most. And that's going to be location plus volatility. When you have an indicator that tells you you are at the beginning of a higher probability of large volatility check, and you are at a location very near support or resistance, you can expect a large move in response to the combination of location and volatility. In a nutshell, that's the essence of sniper trading, which tries to find compound critical states based on both abnormal locations and abnormal volatility conditions in multiple time frames, and then that gives you insight into when to be prepared for these kinds of sharp directional moves. Check or hold. Let me stop there and ask for any clarifying questions if you have any. Those are exactly the kinds of things that in your OBUG meetings you should be looking for. The combination of location and volatility is an absolute winner. Dan asks, do we have something in your figure that goes back a couple years? Well, just if I could put in a plug for my Patreon, there are 7 years of weekly archives that shows the weekend report for the last 7 years. There's almost like 400 of those, and the same number of dailies. So there's probably 1,200 daily reports that are organized by date. So the weekly one, it's like tortoise weekend reports, and then my numbering system is year, 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 month, month, day, day. So it would be like tortoise weekend reports. This weekend's report is 2024-09-14 because that's the Saturday. And then that would give you the report that we're going to review in a minute. So there's 7 years of all of the signals and patterns that you're about to see. And what I do on that is so we go through a Monday through Friday where each day I'm doing a daily report and updating it Monday, Tuesday, Wednesday, Thursday. Then the Friday report is the closing report from, the daily report from Friday, plus the weekend update, which resets my brain for the week ahead. And then the weekly report gives me some of the longer term indicators, and I use that to frame my trades for Monday, Tuesday, Wednesday, Thursday, Friday. So that whole week as a sequence comes out of what I think of as the base weekly report. That's what we have, the 7 years of weekly archives. And then each of these days has a daily report. Now, it turns out that the set of indicators that I use on the weekly report, the significant ones for day-to-day swing trading, are also included on the daily report. So there's some synergy. But there's a few more that I put on the weekend report that has longer term, more persistent, slow to change insights that I don't necessarily need to see every day. So we're going to take a look at that, because one of the ways in which that I should probably answer to the question is, the question you're asking is, hey, what does Ken look at to establish market context? Sort of like market classification, context. What are the things he looks at? Well, it turns out that the daily report has a set of indicators, and every indicator that I look at to get market insight is on the daily report. And everything that's on the daily report, I look at every day. So there's nothing I look at on a daily basis that's not on my daily report. And the same thing for the weekly. Everything that I look at on a weekly basis is on the report, and everything on the report I look at. And there's nothing that I look at that's not on my weekly report. So for me, everything that's on my report is both necessary and sufficient for me. Now, your mileage may vary. There may be other things that you do. But in terms of dashboarding, a decision support system that's designed to support you, you should figure out whatever your all source information is. So let's just call that all source. All of the things that you need to make your decisions and nothing extra is what should go into your dashboard. It should be necessary to look at, meaning that if you didn't look at it, you'd be missing something. And it should be sufficient, that everything you're looking at that's on your daily dashboard or weekly dashboard should be enough. Like there's not extra pieces of news that are floating around out here in an undisciplined way. And what you get paid to do is to figure out how to go to a world of infinitely complex information. Like there's not a shortage of things to look at, but you got to decide what gets to cross over into your dashboard. You don't need to see everything. You only need to see that which is both necessary and sufficient in order to support your decision making. That's the symbol for a decision, is that inputs come in and it's going to go yes or no for action. And to just wait and see is a decision not to act, which is, it's actually a decision to act and to do nothing affirmatively. So you need to think of the decisions that you make and personalize just to you, and don't let other people with their ideas and directives and guidance overrule what it is that you want to do in the moment. You should be studying that to decide what of that outside information do I need to bring into my decision making. And then you should figure out how to get that information inexpensive or least expensive and time efficient so that you can put that onto your dashboard of whatever symbols and arrows, whatever you want that, you want your dashboard to be, I believe, independent. Like, I like it if you subscribe to my stuff, it helps me. But I try to teach you how to create information independence. So if I get hit by a train or I just decide to quit the business next week, I'm not going to, but I don't know. I want you to be information independent in the construction of your dashboard. And I also realize that if that's your dashboard and if this represents, the amount of your trading activity that is aligned with the way I trade and teach and whatever, it's my intention as a teacher and a coach to make you information independent of me. What I really like about Edge Raider, especially, all the patterns and the sniper setups, and what I think of as the beautiful visual auto framing, all of that you can get from Edge Raider, and you don't need my daily reports to do that. So if you're interested in that, represents a subset of the things I teach, but an important one for all the swing trading, which is why I believe you're here. So I want to put in that pitch for Edge Raider and what I consider to be the importance of information independence. And I just want to say, hey, if you're interested in research, I got 7 years of those weekend reports on Patreon. So again, natural break point there for any questions on that. I think I've said enough on that. What I'm gonna defer and go through these next couple questions also, but I will go over the weekend report just to give you some insight into how I use that to think about swing trading and setting the context going forward. Bob Gardner, rest in peace, used to call that the market mosaic because there is, if that's my dashboard, there's little pieces and parts of it that come from different lenses. And as you start assembling the pieces and parts, you start to get an emergent view when you step back a little. If you get too close to that, sometimes you can only see the thing right in front of you. But if you step back, you start to see a wider view. We would call that emergent, where there is more information available than just the individual sum of the parts. So getting that different layers of perspective, different time frames, is one of the things that I advocate in order to get a wider view of the market, a strategic view, as well as a tactical view where you zoom in for a specific trading opportunity that you're going to frame. And because the patterns and the framing techniques and the processes that we teach are fractal, it turns out that the techniques that you use when you're framing long-term swing patterns, the way that you set that up, here's my risk, here's my entry long, here's my stop, and that may be a stop and go short, and then my target is up here. The same kind of mentality that you use to frame the long-term swings is the same thing that I do to frame short-term intraday trades. And so the proficiency, professionalism, best practices, standard work that you do on swing trading is really the same thing that we teach on how to do day trading. It's the same name patterns. It's just that the frequency of your actions and decisions intraday happen a lot faster. Whereas if that's one day, you're making 10 or 15 trades with the standard patterns. If you express that over 3 or 4 or 5 days, it's the same patterns, but expressed over a longer time frame. So I want you to realize that there is synergy in the way that we frame our reward to risk and the way that we set up the different charts. Okay. Question 2 from Ludovich. When testing swing setups, what benchmark should you go for? Is there, and this isn't important, is there any reason to keep testing with different variables with the swing systems if they have a good enough return? Why not just do that and manage with good position sizing and portfolio management? And then are there other strategies to discuss? So as usual, Phil and Griff come up with really good answers. Targets for performance with the swing systems under current framing conditions, a win rate of 65%. So that's a 2-to-1. And average profit and loss at 2.4. I'm going to take that to be a 2.4-to-1 payoff ratio. Correct me if I'm wrong on that. That's how I think you're doing. And then your profit factor of 1.5. I think that's suggesting a 3-to-2 payoff ratio. Phil, which one of those is correct?
Yeah, it's
3-to-2,
yes, the gross profit to gross loss ratio.
and that's the profit factor.
Yes.
Okay, so now what you have in terms of the coin flip, I call this the coin flip, and I consider that to be, in my mind, more important than system quality number per se. Like the first thing I do, as long as you have a sufficient number of trades to perform statistics on, you need a minimum of 30. I would prefer 100. I really want 1,000. But as long as you have 30, you can begin to do the coin flip analysis. And as long as those are all being traded with the same rules, then I care about the win rate of 2-to-1 and then a payout ratio of 3-to-2. That tells me I have 2 out of 3 times I'm winning, and when I win, I get 3, and I lose 2. I'll tell that's pretty good. Why would you ever need more than that? Is Ludovic's question, especially if you're holding less than 15 days. Well, in my view, if this little stack represents your independent trading systems that are all above, historically are above, let's say, the minimum criteria line, then you may also find that there are moments in which maybe only these are at a sufficient level of proficiency that you want to put money on. These are good long-term systems, but are not performing above the current level. Well, you never get rid of those systems because long-term, they have long periods of time in which they work. This may just not be the time they're working. So if I looked at the time series of expectancy, and let's call that a 30 trade expectancy, 30 trade rolling expectancy, I might say, you know what? I only want to trade it when it's north of that line. So as long as it's above, let's call that 0.2. As long as it's above 0.2, I'll take all of those signals. And even here, although it's starting to come back towards normal, this might be 0.3. I'll still take it, but it is out of its sweet spot and now coming down. And at 0.2, maybe that's the long-term average of expectancy. Maybe this is where I start going to half position size until I get to some level where I no longer trade it, but I keep taking it on a paper trade basis until I can find when it's back aligned with the market. And now I can start putting on regular size and maybe double size. And then when it peaks, maybe I have twice the normal exposure, and then I go to 1 times normal exposure until I go just to paper trading. So I'm performing that kind of analysis on the time series of each of these systems. And I'm always looking to add new systems before I need them, because I want to deliberately develop systems on my time frame. And then if I need them, I have them. Now, let me tell you what the hardest thing in the world to do is, and that's to find a positive expectancy system. Except when you have a positive expectancy system and try to figure out how to make it better. I have a whole advanced lesson on the trade quality index. Griff and Phil, correct me. I don't think we have that in the course, but the trade quality index is a method of going to swing trades that have positive expectancy and then ask the question, are we getting the most that we can out of that? What about when those things fail? Is the failure of one of our swing trades actually a good idea to go in the other direction? So let me tell you how that develops. So my favorite long-term swing trade pattern is the 5-day down. And I traded that for over 5 years with a mechanical entry. So I had 5 days down that terminated in, this was the setup day. And as I think we talked about last week and in the course, my mechanical entry is 5 cents above and my initial stop is 5 cents below. And then this becomes, in my mind, conceptually, the yellow zone. Let me put that in yellow, sorry. That becomes the yellow zone in which intraday I can trade if I have a 2-to-1 inside the day. But if yesterday was a doji, I'll never get an intraday trade. But I'm ready to go long if it breaks north of yesterday's high, and I go back to the 10-day high, and I use that as my reasonable reward. And then I take this risk, and then I compute the reward to risk. That's nothing more than the auto framer that Edge Raider gives you. That should be a review. Well, I traded that 5-day down every day for 5 years and got approximately these kinds of results. And then I said, I wonder if I'm getting the most use out of that. It turned out when I did the trade quality index that if the 5-day down ever failed and hit that initial stop, this was a great trade. And as we're going to see in their answer, that's because a 5DD trade could end up being a 6DD setup, a 7DD set. So whatever it was that made this thing horrible for 5 days in a row, which gave us the insight that it might be ready to rebound, it may be that there's still more bad news coming, and this thing could go all the way out to 10DD. Well, wouldn't you like to be short on something that was already a 5DD and is failing? So It took me 5 years to realize that that was a question that I should ask. And the 5DDF is a great short signal. You know when it's even better? When the market classification is in a bear. If you're in a bear market and you get a 5DD, you should go long. But if you get a 5DDF, you should really go short. You know what else that works for? Washout patterns, 551W, triple screens, channeling, and overreaction in bear markets. In bear markets, the failure pattern of any swing trade should be a high priority for intraday short side trading. And then if it works, keep 20% or 10% of the position for the continuation, but make bank on the intraday benefit that you got by understanding the failure pattern. So I didn't know that until I did the trader quality index. You know what else I didn't know? I traded those patterns for 5 years, like the washout pattern, and got a favorable. And then after I closed the trade, it took me 5 years to figure out, hey, as long as the original stop never got violated, and maybe I exited here, if this thing kept drifting, but then gave me a Kata 2 reentry, I should take that. I should keep taking Kata 2 entries as long as I'm getting rising lows and the original stop was never hit. So you can actually get 7 to 8 Kata 2s in a row. And all I ever did for the first 5 years of trading these patterns was just take the first one. And when it exited, I got rid of the information that was available to me. Hey, you just had a successful trade that reversed the direction of a large sell-off. That thing might want to keep going. That might actually be the turning point. So the trader index, the trade index, trade quality index, is a way to start figuring that out systematically that works really well with the swing trades. And all that you need to do if you have XLQ is have the following days: the day I entered and the day I exited. So whatever date. I can't believe I'm just giving you guys this. Is crazy. So if this was 10 August and this was 15 August, this date minus that date will give you 5 days. And that's the time in trade, or T. And then what you do is you just say, look, for that swing trade, I'm going to take 2T and look at 10 days and say, if my trade entered here and exited here after 5 days, let me go out 2T and see what happened in 10 days. And let me find the highest high and the lowest low. And maybe this is the 0 line right here. So this was a winning trade. Well done. So if you go find the highest high and the lowest low in the 2T time period, you can then figure out on a scale of 100 to 0, where on average in that 2T index am I entering and what am I capturing? And then the distance between where you exited to the highest high is what you're missing from this positive signal. Your 1R stop protected you from experiencing the worst adverse excursion, but that adverse excursion, in other words, the stop and reverse, if this is a large number, it turns out that the failure trade is a great trade. And that's what I learned when I did this. I found that when I analyze my patterns, I should care about where the highest high occurred. If most of the time the highest high is occurring in the T time frame, then I was seeing the maximum favorable excursion, and then I was exiting, and then I could say, how much was I giving back? But if the highest high was most of the time after I exited, it was telling me that there was another set of additional trades, and what I needed was a re-entry. So it wasn't until I did the trade quality index that I had a systematic way of determining if the failure trade was worthwhile, if the re-entry trade was worthwhile, and if my exits were allowing me to preserve most of the favorable excursion in the 1T time frame. That is a powerful lesson that I'm ready to teach a separate longer course on. And if you can just give me the date of entry and the date of exit, we can run that analysis for each cluster of patterns. Like if you just put all your washout patterns in one, we could do that for each of your swing patterns. And we would offer that as an analytical service to you, as a way to refine your understanding. But I've given you the magic formula already on how to do it yourself. If you have any proficiency in in the spreadsheets, you can do what I just said. Now, that's how you can do more with the trade systems and rules we're giving you, give you this. What I just described is a way to do more, to continue to calibrate parameter optimization gently and carefully, and then understand why you want a time series using 30 trades as a rolling pattern to determine how carefully and closely aligned your system is performing, and use that to decide when to increase or decrease your actual risk. Guys, that is the secret to success. That's the next secret to success, I would say. You should listen to that as many times as you need to till you fully embrace those ideas. So you want new systems ready to go before you need them. And then you should only be trading the systems that are in the sweet spot based on the time series of performance. And what that is doing is recognizing that the market itself looks like this going through time, and it has a time series of performance, and your individual systems are subsets of the market, and that has its own little time series. So when it's out of tolerance, you shouldn't be trading it. And when your system is working above average, then we know that you are in perfect alignment with a market that is designed to give it good performance, above average performance. So what you're doing is using the performance curves in the time series to align your swing trading systems with the market's condition. And then I'll tell you, you will have discovered the actual secret of market classification is not to come up with a pretty good 9-state model like we have, which is pretty good, but your market classification is nothing more than the sum total of the performance expectancies of your systems time now. The market is in a state right now that is giving you these performances in your systems, and it is the performance of your systems collectively which tells you what the actual useful market classification is. So you should be using the performance numbers of your systems ultimately to decide which ones to trade, and not because the market is in some kind of theoretical condition that you've developed, but the classification that matters is the results that you're getting. Wrap your head around that as many times as you need until you realize the wisdom of that saying. check or hold. Guys, that is such a big idea that you will have a perpetual, persistent, robust edge once you internalize that. Then what you're doing with your systems is coming up with each system is itself an indicator about the market. And the performance of that indicator is telling you which ones you should trade and which ones are getting close to trading and which ones are really good right now. That's all you ever want the market classification system to do, is to tell you which systems you ought to trade. If you have a systematic approach to measuring performance over time, the system itself will tell you when it's ready to trade. So always paper trade them forward until it comes into its historical beginnings of a sweet spot, and trade it as long as it's in the sweet spot. Now, Lewis asks about the 5DD entry. This is a really good question, and the answer that the boys gave is really good. Here's what Lewis asked: 5-day down, and let's say that it was a big day down, and it doesn't hit that. Let's say it's a small day down. It's a bit easier to show. And it doesn't hit the criteria for a failure trade, but it doesn't hit the criteria for the entry trade. So let's draw that one now as there's my setup day. And then this in the middle here is my yellow zone. Well, maybe the next day is a doji, and the next day is a doji, and the next day is a doji, and then it comes down, it monkeys around, and it never violates the initial trade framing. And then on the 7th day, it breaks out to the upside. Is that an entry? Yes, it is. Why? Because the original limit to the painful selling was never violated. This is what we would call failure to fail further, and that is information. Failure to fail further is information. And when it finally breaks north of this, we have enough evidence to say that this is a reward to risk ratio that's favorable. Now, remember, we checked it against a 10-day high. And what we said was on day one, there was at least 2-to-1 to the upside. So it is a reasonable price target to expect that it could get to that level. It just took 7 days to begin that move. But that reasonable price target is still there. So the 2-to-1 reward to risk ratio is still there. Now, here's what could actually occur that would be fun. If you adopt our method of Kata 2 challenge, you would find that this is the low. You might find that the RL10, which I'm going to draw in let's see, purple. You might actually find that the RL10 did this, and on this little bump got to here, and then held support and now is breaking out. You can actually combine these ideas so that the 5-day down and failure to fail, you're going to see that there's a supported spring crossing entry here, and you'll find there's a Kata 2 entry here, and you would find there's an emerging dragon entry there. So it turns out that the longer that it goes without failure, the more positive I feel about its ability to return here. And now I might be able to get a smaller risk box and now have less risk or a larger position size, and I can still maintain the original 10-day high up here as my reasonable upside price target. So that initial swing trade pattern of a 5DD allows you to begin to trade frame other methods of trading that build on that as a good starting point. So, yes, it did not open inside the real body. It did not take out the mechanical entry. As long as the original, low of the 5DD was not violated, this remains a valid entry. Anytime it comes and breaks north of that, that remains a valid entry. I don't usually go past 7 days, because if it hasn't broken out of that in 7 days, it's no longer a 5DD anymore. Now, you know what it is? If you got 7 days in a row and it stayed inside here, you're going to get an abnormally quiet 5 day sideways. And then that's going to give you a breakout box that looks like this. Only now the reason to trade it is because of the absence of volatility had made this an abnormally quiet move. And we would think of that as a sideways quiet channel. And in our sniper trading, we want to see it as a Z3 pinch. Z3 pinch. What would happen there is that the Z3 lines of the Bollinger Band will have compressed to such a level that a breakout from abnormally sideways quiet channel, the Z3 pinch, is now a really good trade. So the reason to trade it went from 5 day down to a Z3 pinch, but it never met our criteria, so we never got in. So that's a way you can actually start getting chain trading. Excellent book by Curtis Faith, and it's a popular book, meaning that a lot of people have read it and have internalized it as a set of rules. If you know there's a lot of people that are complying with a documented public rule set, you now have a way to trade that. You can either trade with it or trade against it in ways that make sense. That's your choice. He makes a very good point about don't try to optimize a good system with a few trades, because you're going to wrongfully attribute validity to the entire trading strategy. That's correct. Here's how I think about that when I'm teaching our guys. Understand your histogram. If you've got a histogram that looks like this, with your trades, what I look for, and I think I covered this last time, but it bears repeating. If this is my zero line, these are losing trades and these are winning trades. I look first to see at -1, 0, +2. The first thing that I look for is no trades less than or worse than -1. What that means is I was able to establish a 1R loss and I take my exits. I don't let it go to a fat left tail. So that's the first thing that I look for. No trades worse than -1. Then between -1 and +2, I'm looking for something like a normalish looking curve with about 80% of my trades, 85%. And I want that to be positive expectancy. And if I have that, then I get paid to keep following my rules with positive expectancy in a natural, frequently occurring situation that's positive expectancy. And then the third thing I look for is occasionally a fat right tail, where my rules allow me to experience abnormally large wins. So if I can have that, if I can protect against abnormally large losses, have a positive expectancy between -1 and +2 with the majority of my trades, but some of them can experience abnormally large, then I have everything that I want in my trading system. Now, rather than going to the exceptional trades and then trying to fine tune those to go change my rule set from a few simple rules to a very baroque, complex series of trade rules that allegedly will give me more of these. It rarely will. All I want to do is find ways to make micro improvements to move the entire histogram a slight nudge to the right. Like all I want to do is make a 0.25R improvement on every trade. So let's say I had 100 trades, and maybe on only 40%, and on every trade, I'm trying to make a 0.25R improvement, a slightly better entry next time, a slightly better exit next time, so that I could make a fractional R improvement. And maybe I can only do that on 40% of my trades. That means on 40 out of my 100 trades, I'm able to make a 0.25R improvement. That equals a 10R improvement. I would rather do that, try to make continuous, sustainable, robust improvements to my rule set to move the majority of my trades to the right a little fraction. And if I'm only 40% successful, I will have added 10R rather than trying to over optimize some rules to get the mythical 10R trade instead of trying to warp all of the successful positive expectancy rules to get one more 10R trade, which puts the entire enterprise at risk. I just want to try to make a slight improvement with professional attention to detail, acting just a little bit quicker, a little bit faster, a little bit better, re-entering if I need to, adjusting my position sizing, whatever. If I can make those little micro improvements, I'm nudging the entire histogram to the right, and now I will not overfit a few exceptional abnormal trades. That's essentially what Curtis Faith is recommending to avoid, avoid over-optimization. Avoid over-optimization. But more importantly, although Curtis Faith, great, Howard Bandy, who you should listen to everything he says, his techniques with Safe F and CAR 25, does the same thing to validate the significance of results and not just get droning on in a small sample size. That's the principles that we're teaching. That's the importance of the 0.25R improvement. So if you look at my coaching approach, and I recommend that you listen to the coaching session that I did this morning, I'm going to make the whole thing available to you. I'm spending a lot of time, all my time, on how to make these kinds of micro improvements, not just to the rules, but how we put them into practice. Because you got to check the alignment of what your rules tell you to do and what you're actually doing. Somewhere in there is a way to start aiming for improved professional craftsmanship to improve your trading practice on all of your systems. That's the same mentality, by the way, that is always looking for new systems before you need them. And it's looking to make continuous improvement on the systems, even when they're positive expectancy. That's where you're going to get the most out of pretty good rules. Griff, I don't think I think that's all we needed from this one.
Yep.
Right. Now, what I'd like to do with your permission is just show you a few things. This is that coaching book that I wrote Friday night. This is what you'll find inside of it. I took the 30 most important rules or ideas about resilience, which begins with an R and is therefore important. And these are the lessons that I've learned with my little spirit badger. The spirit badger is important to me as my power animal, if I can say it that way. Because in my journey to competence, once I've discovered who I am and I get out of the traps of being an introverted expert, reluctant leader, and anxious perfectionist, once I get into the developmental phase, I've taught myself those lessons or learned those from a good teacher. Now, when I'm in the development phase, and I want to be focusing on the most important things that lead to improved performance, and I want to be a diligent student, it turns out that the persistent badger is the resilience that allows me to keep marching towards high performance when I can learn to be aligned with my best vision of myself. I can aspire to become a master craftsman, and I can be a resourceful catalyst in helping others learn in a capacity as a mentor. It turns out that the resilience of the badger is what allows you to keep going from point A through the wilderness to your successful high performance in B. This is a journey of 10,000 steps. What allows you to keep going when there are rain clouds and lightning strikes? It's the thick skin of the badger allows you to persist, the protection against harm. And the badger also brings the tooth and claws to do the work. And the persistence of the badger is such that, you know what, I dare you to try to be an obstacle on my path to where my vision says I need to go. I just dare you to try and stop me because I have the teeth and the claws to do the work, and I have the thickness of skin to protect me against the harmful elements. So that is what resilience means for me. That's what a spirit animal does for me. That's what being a Dharma warrior does for me. That's my trail boss who's watching my entire progress up the scale of performance as my silent witness and my internal coach. That's what the trail boss is doing for me. That says, while I'm developing, I got to be making enough success to keep going. And the trail boss keeps me accountable. Well, that whole model of coaching about resilience is what you find uh, in this book. The 30 lessons that I've learned about resilience from coaching traders, coaching athletes, coaching doctoral students who need that kind of persistence to fight their way through to discover new truths. And when I'm coaching, I got 45 years of coaching Army leaders in a challenging profession. And these are the things I've learned about resilience. And it's in the form of 30 important topics. At the start of this thing, the self-assessment instrument asks you about 20 questions so you can figure out which section where you ought to start. And then each one of these essays has 3 quick wins and then 5 longer term projects to do with the coach. But that'll get you started on your own path by yourself. You don't need me. But if you're using me as a coach or anybody as a coach, these 5 longer term projects are the kinds of things you need. And each one of those essays includes 7 to 10 resources for additional study that will support you on these projects and with your quick wins. So the self-assessment instrument will help you pick the ones to get started on right away. The reflective journaling is the technique that I teach to use the Aristotle style of self-reflection, protreptic, to keep going and document your progress. And protreptic coaching in the style of Aristotle, it doesn't start with a way that you must be. it says, look, however you are is a unique person in the universe. And your job is to figure out what that is and what works best for you. And if that's your internal space and you're trying to figure stuff out, protreptic coaching simply offers a systematic way of reviewing everything that you're trying to do from different perspectives to see what you can learn when we simply cast a light on that. And the reflective journaling in the protreptic tradition teaches you how to adopt different points of view for self evaluation. Guess what else does that? All of the creativity research that we've done with Angus Fletcher uses true storytelling and multiple perspectives to see what new stories can come out of the experiences that you have. That is a powerful force for creative self development. And when you combine that with, you combine creativity with the generation of resilience, you have an unbeatable combination of successful improvement of performance in a way that is aligned with who you are on that journey of self discovery. And you can do that by yourself or with a coach and or in a team of fellow travelers who are mutually supportive. That's the best way to do it that I've found in 45 years of doing this. And how to do that is described in some of the essays that you'll find in that book. To give you, if I gave you that book, you might not do it. If I make you have skin in the game, you might do it. So I offer it for sale for 97 bucks on the Patreon. If you buy that book and then later you decide to do coaching with me, you get a $300 discount because you bought the book. Because if you just did the coaching with me, you get this book. But if you do it in steps, you get a discount. So that's the way I would prefer that you do it before you spend a lot of money coaching with me. Spend a little bit of money to see if this is the kind of coaching that works for you. Those are the 5 categories of resilience training: emotional intelligence, balance, mindfulness, etc. This is the table of contents for all of those individual essays. This is the consolidated list of trading resilience books that are referred to in the 30 essays. 2 of them are mine, because why not? So there's 30 books that are generally helpful. This is my background as a coach and as a trader. 45 years with Department of Defense coaching leaders, 35 years or more active trading, 25 years with THARP, etc. You know me already. This is what I'm doing now with coaching with AI and Silicon Valley and DARPA, the guys that I can't tell you all those details, but it is likely focusing on advanced decision-making systems with AI. That's the unclassified version of it. This is the reflective journaling guide, how to do it in the protreptic tradition. I'm going to scroll through that slowly. So if you don't want to buy the book, you can just take screenshots of this video and you have it. Or you just ask me, I'll send it to you. That teaches you how to do the self-coaching in a protreptic style. That's the kind of coaching that we do. This is the self-assessment instrument. Depending on how you score those, it will guide you onto which sets of essays to go after first. Like if emotional intelligence and work-life balance is the problem, start with the first 4 essays. And it summarizes the quick wins, etc. So enough of that. If you let me, I'm gonna do the weekend report after. I'm gonna go visit the website and show you where, if you're interested in buying that, you can go buy that. I think it's on this page. Yeah, if you go to my Patreon page, near the top, you'll see this. You click on that, you can buy that book. This is the same Patreon page, patreon .com/Ken Long. That's where the archive of if you just type archive in the search box, you'll find, well, that's where the book is. That's where you'll find the 7 years of weekly reports. You might also be interested in, oh, that's the Kata 2 systems thing. Now, this book for $47.95, the guy that you see in the coaching session that I send you went through 2 years of all of the weekly recorded FAQ sessions, much like this. He went through all the FAQs and coaching sessions and made one note sheet for each one of those 75 sessions and summarized it into a book with action steps and timestamps on where to find key topics. That's the best $50 you could ever spend in terms of understanding our practical application. You can buy our glossary of terms there. That's about 50 pages of technical terms. And then the weekend report is this one. So I think we're ready to see that with your permission. Are there any other questions on anything I've covered so far before I go just take a quick look at the weekly report? If you have, just drop them in the chat. Otherwise, here we go. So the everything that I look at each week is this. Griff, we doing okay so far?
Yeah, we're great.
Okay. You were unnaturally silent. I want to make sure I was still broadcasting.
You're good.
So the
So
very
we got-
first thing that I look at, first page, upper left, we're in bullish normal. Then I look at the multiple time frame NDX. The 2-day NDX is really powerful. In the coaching session that I'm going to send you, you're going to see the research that Hamad did that shows how important the 2-day NDX is with finding short-term symbols ready to pop. There's the 10-day look back, the 30-day, the 90, and the 270, which you would recognize as being a form of sniper location. And then I just look at 4 simple categories. These are the pieces of the market mosaic. I look at where are we compared to the 200-day moving average. If it's yellow, we've been better, but this is actually for the last 180 days. This is actually closer to the 200-day moving average than usual. We're still bullish because we're 8% above it, but we've drifted back towards it, meaning that the aging bull is starting to happen as we get closer to the election. ADX is above 15 and positive, so that's actually good. The ATR percentage is normal volatility. The risk index is still risk on, and it's close enough here. Now, we just had that horrible, large volatility, which decayed. They got super quiet, more than 1 standard deviation above average. That is super quiet. And now it has been slowly gathering steam. And if we look closely, we would see that just tipped into the red. And that says that we are at a critical state near all-time highs, and it's ready to suddenly break higher with sharp volatility or break lower with sharp volatility. But that is the very definition of a compound critical state. These are the things that we're holding in the ETF too. It's the US and finance and US real estate. This is the current lineup of, if we reran that model right now, The internationals are coming along. US real estate is still dominating. I do that for a couple technical symbols. This one is interesting that in the last week, all of the 10 big broad indexes of the world market model went from below their 4-month moving average to above, which means that we are really poised for a global explosion if to the upside, if that's the way volatility breaks. So this is a global compound critical state. I also look at longer term swing patterns with my standard trade framing. This one is a 3-day. This is a 9-day. Each one of those bars is 3 days. These are all 9 days. So this move right here on 3 days is that move on the 9-day. And that was the end of August, or middle of August, I guess. This is the recovery now in mid-September that went here, down and up. This is like a Kata 2, fellas. All this thing did was came back to the Bollinger Band mean, and the dragon held support, and now this is the all-time high. If this thing breaks to the upside on increasing volatility, it could be as large to the upside as it was to the downside, which was a $25 move. So $25 plus 560, this thing could go to 585 on the next burst up, which would be about a plus 5% surprising move. That's 2 weeks of normal volatility that could happen in 2 days. So this is the market's 3-day, 9-day sniper health check. That helps me with both location and volatility. If you got any questions as I'm going, just drop them in. Otherwise, I assume it's either perfectly clear or hopelessly fuzzy. I now am going to look at 3 different time frames. This is looking back 150 days. This was the 150-day low, slightly off the chart. This is the 150-day high. That's the pink line. This black box is the 30-day high and low for the sniper. The blue box is the 10-day high and low. Look how volatile the last 5 days have been. That's a 5-day volatility. And it is 1/3 of the entire 150-day move happened in 5 days twice. So the 5-day volatility, that is the secret of swing trading. You got to know when it is exceptionally quiet on the 5 days in a row, 5 little dojis, or when there were 5 big days in a row and you have abnormally large volatility. That's exactly what the sniper does. Look how volatile these 5 days and then those 5 days were. It went from 565 to 540. That's a 5% move, and then another 5% move that way. You can make bank all day intraday and with short-term swing trading on 30-minute charts. You don't need anything else, if I'm being honest, as a full-time trader. You're going to see what Hamad does with that in the coaching. He's about in the 8th month of coaching. And you can see in the coaching cohort, every weekly coaching session he's had from January to, oh, in fact, there's 4 coaching cohorts. We're getting ready to start the 4th one in the first week of October. So you got 2 weeks to decide if you want to join that or not. I would encourage you to think about it. But you can, when you're in the coaching cohorts, we record each of those coaching sessions, and everybody from any cohort gets to see the nature of the coaching that we're doing, because a lot of it is going to help you when you see other people going through it, and you can get a leg up on it and study to your heart's content. That is the power of collaborative coaching. That's what happens when you work with a tribe that is using the same language patterns and shares a psychological outlook on professional trading that is consistent, accountable, collaborative, and mutually supportive. That's the strongest argument I can make in favor of the way that we coach, and you've seen in the book that I just wrote how we do it. And you can have 2 weeks to try that on for size. Now, if that was the 150-day look back, this is that same lens, but now I zoom in on the 30-day. There's that black box. There's the 30-day high. All of them, Nikki, all of them. Whatever it is that you're working on, that's what we're working on in that coaching session. So the courses I teach you the techniques. The coaching sessions teach you how to apply it to yourself. I would tell you that cohort 1 and cohort 3 are the two cohorts that are most closely aligned with swing trading and targeted day trading. Cohort 2 features some intraday professional traders, including a guy that's managing a very large professional portfolio with intraday trading only with options and futures. If you're interested in that style of trading and what it looks like, listening in on cohort 2 is pretty good. But if you join cohort 4, you would have a year going forward, not only listening to your own coaching, but you had access to the coaching sessions of the other cohorts. So you're going to get a pretty good mix if you do that. No, so the 30-day daily market health check is I'm looking at the RL10 going through the 4 seasons of MACD. I'm looking also at the 30-day high and low. In the blue box, I'm looking at the 10-day high and low. I'm looking at the 5-day high and low, and I'm looking at yesterday's trade frame. That's the yellow zone for tomorrow, Monday. You'll also notice that I am using anchored VWAPs. I'm using 3, 5, 10, 30, and 150. Because that acts like a giant magnet. This green line is the 3-day anchored VWAP. Because we're so far north of that, that tells you there was a lot of buying pressure that was pushing that higher. That shows the aggressive short-term nature. The slope of it tells you it's getting bigger each day. This is the 5-day anchored VWAP. It also has a positive slope, and that means there's some 5-day buying pressure. The anchored VWAP for 10 days, the time series looks like this, the blue line, and it's just starting to curl up. That means there's some swing traders that are just starting to add to the buying. The 30-day is this anchored VWAP. And there's been, since the sell-off, some persistent buying as we go. So that looks at that one, and then I break it down. The next one is I look at a 30-minute chart. There we go. So you can now see the path that it's taken using 30 minutes. Now, Alex asks, it seems like ETF2 went from 100% to 10 and then from 10 to 100. It seems the large volatility has already happened. Well, this is what I would say. To understand what that means is the ETF2 system is looking at an index where at its own 4-month MA. If that price is slightly above, it's going to say add 10% exposure for that one index. And so you have 10 indexes in that model. Each one is independently 5, 6, 7, 8, 9, 10. Like the top 4 are SPY, the Qs, MDY, and the small cap. Then there's one for US real estate, which is kind of a non-equity. And then you got 5 that are global. Now, it just so happens that all of them except SPY are very close to their 4-month moving average. Last week, they all closed underneath their 4-month moving average, except for SPY. So they all went from positive exposure to negative. So it wasn't necessarily that much volatility. It's just that they were all very tightly clustered around the 4-month moving average. Now, to be fair, the last 5 days have been a pretty strong upward move, a plus 5% move, and that's a pretty significant move. But the reason ETF2 went from 10 to 100 is not because that was a 5% move, but only because all of the indexes now went from below their 4-month moving average to above. So that is why that model quickly gets us back in. But historically, anytime those models themselves, those indexes are above their 4-month moving average, that has always been a positive sign. It's sort of a special case why it went from 100 to 10 back to 100. So you need to know that. But that's also why I look at multiple indicators for volatility. The more important signal for volatility, in my view, the fact that volatility is just getting ready to explode, is the fact that the risk Z has gone from a period of exceptional abnormal quietude because it's more than one standard deviation above the zero line. That tells you this is abnormally quiet. And the fact that it came back down to the middle of normal volatility and just starting to hint to the downside tells you that we have not experienced an amazing astronomical volatility yet, but we could. That's what that means. Is that clear? I want to make sure you understand the difference between the insights. This is where that market mosaic comes into play. You get this little piece of the pie, and you get this little piece of the pie. You get these other market mosaic things. You get this mosaic, you get that mosaic. All of those things are going together to update my view of market classification, market condition for the week ahead. That's why I want to say that. All right. So there's the 150, the daily, and the 30. Now we get into this is where I use these are the symbols that I use for the 13 ETF blended monthly rebalancing portfolio. Now, for the BMR, all I am doing is blending the 3-month and the 6-month with 70% of the 3-month and 30% of the 6-month to give me the blended performance. And then I rank this on the basis of the blended performance. And then this is the cut line between average. This is above average up to +1 standard deviation. That's why they're color coded white. This is the only one that is more than 1 standard deviation above average of this set, of that set. Okay. These are the ones that are below. This is more than 1 standard deviation below. But it turns out that these blended monthly rebalancing candidates that are in extreme locations can often give you really amazing results. So I also calculate it on a 1 week and a 1 month to help inform my shorter term swing trading. So I'm using longer term models to inform my shorter term target selection. So this is ETF 13. In ETF 22, I take ETF 13 and I add 9 of the sector spiders like XLU, F, P, Y. And it's not unusual to see them having extreme either at the top or at the bottom. And that's one of the reasons you would add sector spiders, is because you get correspondingly bigger or worse moves compared to the big fat indexes, which you find in ETF 13. And then you can see that like XL Energy is so bad that I'm really interested in it as a potential rebounder. So I can use that to go help me find short-term swing trades just on the basis of its abnormalities. That's some advanced swing trading right there. ETF 32 now adds its ETF 22 plus some new global indexes like silver. Let's see, some agriculture, Australia, Brazil, the individual countries, China, that kind of stuff. So you read it the same way. And I just like what is really dominating and what is hot right now, silver as a defensive mechanism. Now that the market is pushing all-time highs again, what if there was a big sell-off? Then silver would probably bounce as a reaction against that. So maybe that's guys that are pre-positioning. I don't know, but I could set up that trade. The next thing I look at is ETF Max. So now I'm looking at a couple hundred symbols that have at least 500,000 shares daily. So this gives me my widest possible look on. There's about 180 of them that have more than 500,000 shares. So these are the bottom feeders. These are the top 30. I skipped the ones in the middle because they're not interesting. It is from extreme conditions that extreme follow through is. These are either going to be hugely up or give back a lot. And these bottom feeders are either going to, well, look at clean energy and natural gas had an extraordinary week. So that sort of shows you why I'm interested in the very bottom of the symbols. Like, I wouldn't be surprised if both of those continued their weekly momentum for another week. So I'm going to stock them. And it turns out that PBW is liquid enough to trade. So these are ways that I look for understanding the swing trading condition and opportunities of the market. So this is where that ETF2 looks at those 10 symbols. It looks to see which ones are above their 4-month moving average. They all are. So that's why this is 100. Last week, only the S&P was above, as I just previously described. And I just look say, hey, the bullish normal. The S&P is stronger than the global Euro-Asia blend. Inside the U.S., it's the S&P, small caps, mid caps, tech, etc. I then look at the sector spiders the same way. I look at the broad asset classes. Right now, the S&P is pretty good, but U.S. real estate and gold are dominating in the green. So U.S. real estate looks to me like it's receiving a lot of equity money that's being stashed from big wins in the market, and they're plopping it into U.S. real estate until we get through the election. This one takes that ETF2 database and then expands that to look for things that are exceptionally good, above average. And then I use this little strategy set to assess the strength and consistency of ETF2, but now to use for swing trade generation. Like there's a model that I use for ETF2 trading in a formal system, but this is a relaxed way of looking at an assessment, a swing strategy. Can I turbo it intraday and why? That's advanced swing trading that's covered in my advanced swing trading course. But these are things that I use to look at the market model. And then there's one more that I look at, and that is I just like to know which of the ETFs are both exceptional daily liquidity, that's the 30-day average trading volume times the current price to tell you what the how many dollars are being slung around on these different symbols. And then what is the ATR percentage? The ones that are on this list are the 30 most liquid ETFs, and the ones that are also a high degree of intraday liquidity make the best day trading candidates because they're very liquid and they're very routinely volatile, like semiconductors. That's why I trade NVIDIA, Intel, AMD, Taiwan Semi, the S&P technology sector, XLK, and then regional banks, biotech, gold miners. Those are the best intraday targets on the basis of liquidity and volatility. So when I'm looking for things to trade, I can trade those. Now, those are the additional things that I look at every week. Now, before we're almost done. When I said I look at the weekly report, and that carries me from ready to trade Monday all the way through till Friday, I believe those relationships that I just described give you a week at a glance. And then because I also day trade these things, I end up doing a daily assessment for Monday, Tuesday, Wednesday, Thursday, and Friday. And that's if I'm swing trading, that's swing trading one day at a time. Or I may get a swing trade signal for Monday and it works for 3 days or 4 days or a couple weeks. So the daily report is my daily update. The weekly is my reset of my baseline of the market conditions, which are a little slower to trade. So think of that as my operational level, and the daily chart is or the daily report is my tactical. Questions on that? All right, that's everything that I wanted to cover today. We went almost 90 minutes. Appreciate your patience and courtesy. I would invite you to consider all the things we talked about and the opportunities you have. Dan, I notice, is Dan Blum is in cohort 4. He's a resource just to work with on a weekly basis too, by the way. But again, the ability to plug into hundreds of hours of other coaching sessions, you get lifetime access to that, by the way, if you pull the trigger on the coaching. The coaching program lasts a full year, but you get lifetime access even after your year is done. So if you did a year of coaching and that was enough, you would always get to be able to access the ongoing coaching of others because of your support of the program. But if you wanted active coaching each year, you would pay that fee. But my spider sense is that a year of coaching is sufficient to get you to everything that it is that you want to do. Oh, I meant to show you, this was so this is what Hamad's um, weekly coaching agenda looked like. We were talking about how to deal with trying too hard and how to relax a little more. We talked a little bit about his target selection. He has just a handful of symbols that he really concentrates on for both day and swing trading. And this is the little note to self that he does during his trading day as a professional. Is it making a yellow zone breakout? Yes or no? What's it look like 30 minutes in? What's the gap? What's it looking like after the opening 60 minutes? And he uses this to stay focused during the day. He has a little cheat sheet that he made for himself to remind him on how to trade supported spring crossing, emerging dragon kata 2, supported fall crossing, Z3 pinch, OR10, 1, 2, 3s, 2R battle drills, the different exits that he manages, and like the R6 MMRB exit and the dragon. So that's like a professional NFL coach that has his playbook on the sideline and uses that to make all his intraday decisions. This was the way he does his plan and prepare. Those other two were his execute and assess. But this is how he prepares his daily trading plan and swing trading plans. and his numbers look like this. He has a 3-2 win rate and a 3-2 success rate. And his histogram has nothing worse than 1. It's positive expectancy between -1 and +2. He has a fat right tail, and that's his equity curve for the month of September, which halfway through he's at 17R and cruising on his way to a 40R month. If you add his open unclaimed wins, that's his trade production schedule. Each time he makes a trade, he adds the new dot of what the R capture is. What I would do, Lewis, on the small group coaching is I would first master the kata 2 and swing trading challenges and do the coaching that Phil and Griff are doing. When you're ready to maybe take that to the next level, I wouldn't take the coaching that I do until I had really gone through that stuff and ready to go and have a working system with clarity on your trading plan. You need to be at about, I think, 70 to 80% operational on those patterns in order to get the most use out of what I'm going to invite you to do. Because if you're not to that level yet, I'm just going to tell you the same things that they're telling you. So I wouldn't do that until you're kind of get to that level. On the other hand, if you decided to go for it in cohort 4 and started to go through it, and then you wanted to put a halt on it, we would just stop the clock and keep the other sessions open for you. And then you'd have that other stuff available to you. So I think we could reasonably work with you on that kind of an approach. And if you're in the sound of my voice, I'd offer you the same ideas. I would talk with Phil and Griff. I mean, both of those guys suffered through 2 to 3 years of daily and weekly whipping uh, with online and personal coaching. And I think they're in the best position to work with you on whether or not the small group coaching is you're ready for that. Because what those guys did with the as interns for me was essentially daily and weekly coaching, and I think they would be in a good position to help you make that decision. And they could add more if they like. This was that was uh Chi Wing Chong's, who's also in the he's an intraday trader. He's got a system. He's 5 months into the coaching, and for 5 months he's had a system that has a 3-2 win rate and a 3-2 payoff rate and no overnight risk with a handful of simple strategies, only using Kata 2 and SSC. That's all he's doing, intraday only. And that's what his September looks like so far. So, yeah, that's the next layer of success on this, I believe. So that's everything that I wanted to cover, and I appreciate your courtesy and letting me lay out what it is that I think that we offer. And I appreciate your time and patience. And what I owe you is the recording of this session, and also the recording of that other coaching session from this morning. I think you would find that. And oh, by the way, I would listen to that. That's what the coaching actually looks like, and you can see what it is that we do and how we are really personalizing uh, the fit of these individual systems at the detailed level for each and every person. I mean, there's only so much you can kind of do in large group and learning the patterns. At some point, when you're actually in there trading them and you're getting experiences that are personalized to you, at some point you got to look at individual game film and tweak that. And that's really what we're doing in the small group coaching. I'm not teaching the patterns. I am refining performance with patterns that are pretty well understood. That's the way I would say that. Okay. Any other questions before I hand this back over to the fellas for any concluding administrative notes? I think we're okay. Phil and Griff, back over to you, fellas.
Yeah, that's great. Thanks very much, Ken. Yeah, really outstanding information. Yeah, thanks everyone for attending. If there are any follow-up questions, please use the discussion board to post your questions. And we'll have the recording posted, and we'll let the team know when it's available.
And again, we can roll for any questions that come out of this upon reflection. Just roll them forward like we did today into that next round. How many more are do we have one more session
We
program for
haven't
this?
we haven't scheduled.
Let's just do
another
that. Let's just go do it monthly to Thanksgiving or out to
Mhm.
out to Thanksgiving. Yeah.
Okay. All right. All right. Thanks everyone for attending.
Yeah, thank you very much, Ken and Griff and Phil. It was very useful. Appreciate.
Thanks, everybody.
Thank you.
Thanks.